Welcome back, everyone, to the next module in our trading journey. Today, we're going to be talking about another tool you can use in your trading arsenal. This is my personal favorite standalone indicator, and it's none other than the Ichimoku Kinko Hyo. Today's discussion will focus around what Ichimoku is, what does it mean, and how can traders use it as both a standalone system as well as confluence for your trading setups. So let's dive right in. Ichimoku Kinko Hyo literally translates into equilibrium at one glance. It was developed in the 1930s by a Japanese journalist named Goichi Hosoda, who spent over 30 years perfecting this system and did not release it until the late 1960s. Ichimoku is essentially a trend identification system. It has both lagging and leading elements that help create the clouds on the chart. It also employs moving averages in its calculation. But instead of using the closing price of candlesticks, it utilizes the mean or the average of the high and low for the period being analyzed. I personally liken the moving averages in the Ichimoku system as moving averages on steroids, as you'll tend to notice just how well these lines get respected by price action. Ichimoku is a technical indicator that captures anywhere from 70 to 80% of any given trend. This is what I like to call the meat of the trend. As traders, we don't need to perfectly catch tops or bottoms. There is plenty of money to be made riding the majority of a trend. Before I get into the components of Ichimoku, I want to draw your attention to the last bullet point. Ichimoku does not work well in range-bound markets. This is a trend-following system, and therefore it is prone to giving many false signals in a market that is stuck in a consolidation range. If we remember from Module 2 from the previous course, identifying the type of market we're in is essential, since some strategies work better than others depending on the market conditions. So again, I'll say this one more time to really ingrain it. Ichimoku does not work well in range-bound markets. Use the skills you learned in the previous course to help you identify whether price is trending or range-bound. This will save you a lot of headache down the line. With that said, let's dive deeper down the Ichimoku rabbit hole. There are 5 components to the Ichimoku system, so I'm going to briefly introduce them all. Then we're going to talk about how they're calculated, and finally move on to what they look like and how we can use them to our advantage. So the first component is called the Tenkan-sen. This is also known as the conversion line. Whether you prefer to call it Tenkan-sen or the conversion line is entirely up to you. I learned it with the traditional Japanese labels, so I will refer to it as such. This is the first moving average in the Ichimoku, and it is calculated as the average of the high and low for the period being analyzed. Again, as I go through the components, you are welcome to pause the video if the mathematical calculations are of interest to you. But rest assured that all of your favorite charting software will calculate the outputs for you. The next component is the Kijun-sen, also known as the baseline. In my opinion, this is the single most important component of the entire system, and I'll explain why in just a bit. It is the second moving average, and it is calculated by the average of the high and low for the period being analyzed. This period is usually twice as long as the Tenkan-sen's look back. Now the next 2 components are Senku span A and Senku span B. These 2 lines essentially create the Kumo, or cloud as we call it. Senku span A is essentially the average of the Tenkan and Kijun, while Senku span B is the average of the high and low for the look back period being analyzed. Again, this look back period is usually twice the look back of the Kijun-sen. Lastly, we have the Chiku span, also known as the lagging span. This component is basically the current price plotted back a certain number of periods. You might ask yourself, what good does a line that's plotted backwards do for us? Well, we'll dive into that in just a bit, but for now, I want to start putting faces to names. So this is a chart of the Ichimoku cloud without any candlesticks on it. I really want to reinforce the components so we can start to understand how we can use them. Let's talk about them in order. This light blue line is our Tenkan-sen. We'll notice that it usually likes to stay very close to its brother, Kijun-sen. Kijun-sen is our bright yellow line. These two moving averages will help provide us signals for entering or exiting trades using the Ichimoku system. Whenever the Tenkan and Kijun cross one another, a signal is presented. We'll talk about the strength of the signals in a little bit. For now, let's move on to the Kumo. As mentioned, the Kumo, or cloud, is created by Senku span A and B. When Senku span A is on top of Senku span B, we can say that the cloud is bullish. When Senku span B is above Senku span A, then we can say the cloud is bearish. Remember, Senku span A and B are just moving averages. Together, they create the Ichimoku cloud by shading in between them. All of these moving averages, the Tenkan-sen, Kijun-sen, Senku span A, and Senku span B, are all types of support and resistance. The strength of SR depends on price in relation to these moving averages. One thing to remember is that the thicker the Kumo, the stronger the support or resistance. The thinner the Kumo, the weaker the support or resistance. Lastly, here we have our Chiku span. Remember, this is just price plotted X amount of periods back. I'm going to overlay price on this chart in just a minute, but ask yourself, what value do you think plotting price back may have? Hold that thought as we bring in price action. Now, digest this chart for a minute or two. What do you see? What do you notice? How do the candlesticks interact with the different components of the Ichimoku system? Remember, Ichimoku is a trend-following system. The beauty and subsequent use for Ichimoku is mainly used on higher time frames, such as days or weeks, depending on the market you are trading, whether it's crypto or traditional markets. By overlaying Ichimoku on high time frame price action, we get a quick glance at what equilibrium in the market looks like. There are a handful of rules when it comes to Ichimoku, but before we get into that, let's talk about inputs for a second. This is by far the most redundant question I get asked when talking about Ichimoku. What setting should I use? Well, the answer might surprise you, or it may not, based on how well you've been grasping the previous modules in the courses. The true answer is that the inputs depend on your system and your strategy. That's right, there is no right or wrong answer when it comes to inputs for Ichimoku, or any other technical indicator for that matter. There are pros and cons to setting them certain ways. I'm going to briefly go over the various settings. The first is the standard out-of-the-box settings. For those of you who will be trading traditional markets, these settings will make the most sense to you. There are 4 inputs: conversion line, baseline, lagging span 2, which is also our Senku span B, and displacement, also known as our lagging span or Chiku span. Traditionally, these numbers are 9, 26, 52, and 26, and they reflect the normal operating times for traditional and forex markets, i.e. approximately 26 trading days in a month on average, including market holidays. Now, for those of you trading crypto, we tweak these numbers to 10, 30, 60, 30 This helps account for the 24/7 nature of cryptocurrency. The exchanges are never down. You can trade all year long with no holidays. Here we assume an average of 30 trading days a month and base our calculations off that. Lastly, we have what I call the smooth or the doubled settings: 20, 60, 120, 30. Doubling the inputs on either the crypto settings or even the standard settings has a significant impact on the indicator and how it paints. By doubling, tripling, or multiplying any indicator settings by a consistent factor, in this case 2, essentially smooths out the indicator. Whenever we smooth out an indicator, it produces less actionable trading signals. This is true for all indicators, not just Ichimoku. I personally prefer to use the smooth settings, as it forces me to be selective with my capital and only trade high probability setups. This is something I have found from my journal reviews. My highest hit rate on a lot of my Ichimoku based trades are most often found using the smooth settings. However, I want to note the following. The settings you should use are the ones that speak most to you. There is no right or wrong setting. The goal is to be consistent. Frequently switching the settings won't help you master the indicator and will lead to more headaches when it comes time to review your journal. With that said, let's dive right in and discuss some of the rules for trading using Ichimoku. Remember, Ichimoku is a trend identification system. Depending on price's position in relation to Ichimoku, we'll want to take long or short positions. So the first rule is that if price is above the Kumo, as well as the Kijun-sen, and the Chiku span or lagging span is above price, then we can assume the asset is trending upwards and we'll want to look for long opportunities. Now on the flip side, if price is below the Kumo and the Kijun-sen, and Chiku span is below price, then we can assume the asset is trending downwards and we'll want to look for short opportunities. Lastly, if price is inside the Kumo and the Chiku span is inside the price, then the asset is considered range bound and we should not be using Ichimoku at all, since we're in a range bound market. The goal of Ichimoku is to help us identify the larger trend so that we can trade in the direction of the trend. Remember, when we trade in the direction of the trend, our trades are much more likely to play out in our favor as opposed to trading against the trend. If you'll remember from the previous course, the trend is your friend. And remember how I said Kijun-sen is probably the single most important component? Well, that's because you can consider the Kijun-sen as the trend setter. Whenever price is above it, you can assume the asset is bullish. Whenever price is below it, you can assume the asset is bearish. Use this as a barometer as you move forward and explore the possibilities Ichimoku can provide you. In the next video, we'll take a look at some live examples of Ichimoku and how we can use it in our trading setups. Thanks for watching, and I'll see you soon.